Welcome to Opal's TV. Today I'm in Amsterdam together with Ruud Smets from Theta Capital. Theta Capital was set up in 2001 and is one of the oldest and most established allocators to hedge funds in the Netherlands. Theta Capital also runs a very unique hedge fund-to-fund product, and we're going to talk about this a little bit more in detail. But before we go there, Ruud, please introduce yourself and give us more background about Theta Capital.
We're Theta Capital, we're based in Amsterdam. We've been around for close to 15 years and we've always been running money focusing on hedge funds. So we've invested in hedge funds for the last 15 years. We have two different setups. For large institutional clients, we can run bespoke individual portfolios. And next to that we have a commingled fund, it's called the Legends Fund. We run it since 2010 and it's really a unique structure, I think, for investors to invest in some of the very best hedge funds in the world. I joined Theta Capital in 2005. I've been the portfolio manager for the hedge fund mandates for the last 10 years.
Now, Ruud, I've been in the industry for a long time. I've seen many hedge funds, but yours is somewhat different. Tell us more. What's unique about your Legends hedge fund?
There's really a couple of things. First of all, it's the quality of the funds we invest in. It's not only what we say, but these are widely recognized hedge funds in the industry. So it's the top 2 or 3 names in every hedge fund category. One thing that's unique about Legends Fund is that it provides actually access to these names. So these are managers that have been successful for 15 to 20 years, on average 18 years. They run their own money in the first place. They want not to get too big so that it can hurt their performance. So it's actually quite difficult to, as an external investor, to get capacity to these funds. The other thing about the Legends Fund is how we manage the portfolio. We manage it in a transparent and straightforward way, and I do believe that's actually quite powerful. So we invest in the 4 main hedge fund categories: long-short equity, event-driven, global macro, relative value. And within each of these strategies we allocate to the best names that are available. We do allocate to each strategy at any point in time, and we keep the allocations stable. It's 25% on a risk-weighted basis. So, for example, the global macro strategy has more attractive diversification characteristics than, for example, the event-driven bucket. There's a small difference in sizing there. But we believe it's important to be present in the various strategies at all times. We've learned over the years that it's very difficult to time when certain strategies are becoming more attractive. And it's also very expensive when you invest in hedge funds to allow a lot of turnover in your portfolio. And in the end, this will really cost you performance. Many investors left the CTA space end of 2013 after a couple of disappointing years. And then in 2014, our CTA exposure was the biggest driver of the hedge fund returns. Finally, what's really different about the product, and I think very attractive for investors, is the way it's structured. It's a fund that has daily valuations, so every day there's independent valuations from our administrator, and it has a listing on Euronext Amsterdam. So you can actually buy these shares in this fund on a daily basis, and you get access to managers that are typically closed for new investors on a daily basis.
So you're saying you're doing a daily valuation. That means that all your underlying managers need to do a daily valuation. How is that possible in all these different strategies?
It's not that all managers have a daily valuation. I think one of the nice things about Legends Fund is that we really make no concessions to the quality of the portfolio. So compared, for example, to a UCITS fund of fund, we're not bound to UCITS products. The way it works is that every manager does give us estimates. Sometimes it's on a daily basis, sometimes on a weekly basis. We've developed a model for every underlying hedge fund based on market factors that trade daily, on the basis of which the administrator calculates an estimate for each hedge fund every day. So what happens when a hedge fund estimate actually comes in, it overrides the model, and the model will continue from there. When we look over the last 5 years, we've seen that the deviations that you get from the actual estimates are fairly small. And when you have a diversified portfolio, the daily NAV we provide is actually spot on.
So Ruud, you're running a Legends fund. I'm curious, what in your view or in the view of your team makes a legend? So tell us more about these legends that are in your fund.
We define the legends as the few managers within each strategies that have been consistently successful over a long period of time. The average track record of the legends that are currently in the portfolio is 18 years. So they've been around and been successful for a very long time. They run large portfolios. They all run multi-billion portfolios. They have very robust organizations. They can hire the best talent. They can retain the best talent. Another thing that sets the legends apart is the alignment of interest. So typically the funds that we're invested in, they run their own money in the first place. So there's managers in our fund that actually have several billions of their own money invested in the fund. And that gives you a very good alignment of interest. Also to make sure that they are not getting too large or they take excessive risks. And another thing about what a characteristic of this group of legends is that they are mostly close to new investors. So if you want to invest in them, they typically won't allow new investors in. And if they do, they have very high minimums of often 10 to 20 million.
Ruud, what else can you share about the actual performance of these legends in your fund?
Over the 18 years that they've run their portfolio on average, these managers have achieved a 15% net annual return. And I think what's really powerful is the way in which they have avoided large losses. So if you look at a portfolio of legends since 1997, the maximum drawdown has been 14%, which compares to 55% for the MSCI World, for example. The volatility and the degree of drawdowns has actually been quite consistent over time. When you look at the fund, you see that it has consistently achieved about 50%, 50, of the upside of equity markets, while it only took about 5% of the negative performance when equity markets were down.
So if the majority or all of those managers are closed, how do you do it? How did you get capacity, and do you continue getting capacity in these managers?
As I told you, we've been around for close to 15 years. So we have been invested with most of these managers for a very long time. On top of that, we have a strong industry network. In our bespoke portfolios, for example, we run money for some principals of some of the largest financial institutions here in Europe, and often they know some of these legends personally. And also we've been very stable investors over time. So when you build a relationship with these firms and you show to be long-term investors, and they all do have redemptions, some redemptions throughout the year, then you can actually get some of that capacity. A last thing that helps us is that we have a research relationship with one of the largest and oldest hedge fund investors in the world, and they actually have, I think, access to these managers second to none. So we do get the capacity we want. We don't really compromise returns. It's an important starting point of this fund. There's significant internal capital from Theta partners in the fund. And so would the situation arise where we cannot grow the allocations the way we want to, we would simply close the Legends Fund for some time as well.
So you're a fund-of-fund manager. How do you look at risk management?
Well, risk management is basically where it all starts. It's why we invest in hedge funds. They have the tools and the mandate to effectively manage risk, I think. If you look at different hedge funds, different styles, we expect different types of risk management. For example, in a really trading-oriented global macro strategy, you would expect to see a manager to cut losses quickly and let their winners run. While in a more concentrated event-driven strategy, it's more about staying power. So if the portfolio goes against the manager, how can we be sure that he actually doesn't have to sell the holdings at the wrong moment? So it's about asset liability match, the terms the investors have, no use of leverage if you run a concentrated event-driven portfolio, things like that. If you look at the legends, these are very robust funds and they have virtually no business risk. Even though the portfolio is very concentrated with 10 to 15 hedge funds, if you consider the quality of the organizations of these funds, you don't have to worry about gating, side pocketing, some of the things that are putting investors off. And then on the fund-of-fund level, we have our own risk management. We diversify over multiple strategies, over multiple managers. We size our managers such that we are confident that any individual manager won't have too large of an impact on the overall portfolio return. And this actually is the broader principle behind our risk management. So we don't want to have any strategy, any manager, any factor, any theme, any instrument to have a disproportionately large effect on the hedge fund portfolio. So on top of that, we have simple rules like not using leverage, hedging our currency exposure.
When you talk to investors and when you're selling your fund, what are you saying about the benefits that you are offering to investors with that product?
I think the real benefit for investors is that this really offers a strong long-term investment proposition. And one of the main reasons for that is that you invest with managers that are really adaptive to different market environments. So what you have is some of the best investors in the world that actually run your money. They're flexible, they are active in all asset classes, so we have managers in equities, in bonds, but also currencies, commodities, interest rates. And they can manage they manage their portfolios from the long and the short side. So when you look for a long-term investment and you want the smartest people to make the right calls of where to invest and what areas to avoid, I think this is what we aim to deliver to investors with the Legends Fund. And then operationally, I think the structure is a big advantage to hedge funds, as it avoids many of the challenges that investors typically have when investing in hedge funds.
So Ruud, I think, and probably a lot of people think, this is a very attractive product. Now I'm wondering, what are the actual costs of it?
The fees we charge are a management fee of 62.5 basis points, and we have a performance fee of 5% with a perpetual high watermark. I think what's important is also that we do get some deals with underlying managers when we, for example, been invested for a very long time. We have some family and friends share classes. So through that way, investors actually earn back a bit of the fees they're paying us.
So you started your Legends funds in 2010. So since then, how have you done? How have you fared with the product? And also, what's your outlook going forward?
Markets have been really driven up by central bank policies, a lot of liquidity in the system, which has been a difficult environment for hedge funds. If you look at our Legends Fund performance over that period, it's up 25%, and that compares very strongly with, for example, the HFRX Global Hedge Fund Index, which is up only 3.5%. But over this period, clearly a buy and hold strategy of equities and bonds would have outperformed also our Legends Fund. What I think is more important is that it seems we really turned the corner in that sense. Bond prices from these levels have much less upside than there is downside, and I think you can argue that for equity markets as well. We can see in 2015 that the markets are becoming really volatile. We just had the August equity market crash. We had the China Black Monday. And if we look at 2015, the Legends Fund, including August, is still up 3.5%. It managed the downside very well, while equity markets are down 4 or 5% and bond markets are essentially flat. And if you look, our outlook from here is that it will remain relatively attractive for hedge funds. There's many big moves in markets. We've seen the fall in commodity prices in July. We profited from that, both with technical strategies as fundamental strategies. You see divergent central bank policies, which has implications for currencies and interest rates, but also on individual companies. Technological developments create a lot of winners and losers. So hedge funds, I think, are really well positioned to pick winners and losers across individual companies, across sectors, even across countries, without being bothered too much by the overall direction of the market, which could actually be more sideways from here. We can tell in 5 years' time.